6 ordinary situations can quietly shrink your Social Security check, and most retirees never see it coming until the deposit lands smaller than expected, which is exactly why I want to walk through every single one of them with you today. I have spent decades sitting across the desk from people just like you, and I can tell you the pattern is always the same. Nobody warns them ahead of time, and by the time they notice, the money is already gone. My name is Robert Hensley, and for decades I worked as a Social Security and benefits counselor, helping people navigate a system that is not exactly built to explain itself. And I am not here to sell you anything. I am going to walk you through this the same way I would have explained it across my own desk, with no jargon, no overwhelm, just what you need to know. So before we get into the 6 questions, if this is useful to you, go ahead and hit subscribe and turn on notifications, because these rules shift more often than most people expect. And that brings us straight into the first question you need to ask yourself. Question number 1. Are you collecting Social Security retirement benefits right now while you are also under your full retirement age and still working a job or running a business? And if the answer is yes, here is exactly what happens to your check. In 2026, if you are under your full retirement age for the entire year, you are allowed to earn up to $24,480 before Social Security withholds a single dime. But for every $2 you earn above that number, the agency withholds $1 from your benefit. Now, if you are reaching your full retirement age sometime during 2026, the rule is more generous because your limit jumps to $65,160. And above that number, they only withhold $1 for every $3 you earned. Once you actually reach your full retirement age, this rule disappears completely, and you can earn any amount with no reduction at all. But there is a part of this rule that almost nobody explains clearly, and it changes everything about how you should think about it. The money that gets withheld under this earnings test is not gone forever. It is being held back temporarily, and once you reach your full retirement age, Social Security recalculates your benefit and credits you for every single month they withheld, which usually results in a permanently higher monthly check going forward for the rest of your life. Let me give you an example using a composite situation I have seen many times. Picture a woman named Rosalind who started her benefit at 62, earning $800 a month, and then went back to part-time work, earning $33,400 in a single year, well above her limit that year. Her benefits would be reduced by roughly $4,460 for the year. But every dollar of that reduction eventually gets factored back into her check once she reaches full retirement age. So she is not actually losing that money. She is essentially loaning it back to herself at a delayed date. That brings us to the second question, and this one has nothing to do with working at all. Question number 2. Is your total income, including your Social Security, pensions, retirement account withdrawals, part-time wages, and even interest from tax-free municipal bonds, pushing you above a certain combined income level? Because if it is, the federal government can tax a portion of your Social Security benefit itself. Here is how the math actually works. The government adds up half of your Social Security benefit, plus all of your other income, plus any tax-free interest you earned. And that total is called your provisional income. For a single filer, if that number stays below $25,000, none of your benefit is taxable at all. Between $25,000 and $34,000, up to 50% of your benefit can become taxable. And above $34,000, up to 85% of your benefit can be pulled into your taxable income. For married couples filing jointly, those same numbers are $32,000 and $44,000. And there is something about these numbers that genuinely frustrates me, which I want to explain next. These thresholds were set back in the 1980s and 1990s, and they have never once been adjusted for inflation, not even a single dollar, which means that every single year, as your cost of living adjustment raises your check, more and more retirees get pulled into this taxable range, even though their actual buying power has not improved at all. That is simply how the rule was written. It is not a mistake, and it is not a scam. It is just a rule that has quietly gotten stricter every year without anyone changing a single word of it. One thing worth knowing: qualified withdrawals from a Roth account do not count toward this provisional income calculation at all, which is one of the few tools retirees have to keep more of their own Social Security benefit out of the taxable range. And it is worth a conversation with a tax professional if this applies to your situation. Now, let us move to the third question, because this next one hides inside your Medicare bill instead of your Social Security check. Question number 3. Is your income high enough that Medicare charges you an extra amount on top of your normal Part B premium? Because this is one that catches people off guard more than almost any other. It does not show up as a reduction to your Social Security benefit on paper. It shows up as a bigger deduction taken directly out of your check every single month before you ever see the money. In 2026, the standard Medicare Part B premium is $202.90 a month. But if your income from 2 years earlier was above $109,000 for a single filer, or $218,000 for a married couple filing jointly, Medicare adds a surcharge called the Income-Related Monthly Adjustment Amount. Depending on how high your income was, your total Part B premium alone can climb all the way up to $689.90 a month. And that entire amount comes straight out of your Social Security deposit before it ever reaches your bank account. And there is a timing trap hidden inside this rule that trips up even careful retirees. This surcharge is based on your tax return from 2 years earlier, not your current income, which means a single event, like selling a home, taking a large retirement account withdrawal, or even a spouse passing away and changing your filing status, can quietly push you into a higher surcharge bracket 2 years later, long after that unusual income year is over and done with. The good news is that you are allowed to appeal this if your income has genuinely changed since that tax return. Situations like retirement, a reduction in work hours, or the death of a spouse all qualify for what is called a life-changing event exception, and you can request that Social Security reconsider your surcharge using your current, lower income instead of the outdated number from 2 years ago. So if this applies to you, do not just accept the higher premium, ask about the exception. Now, here is a question that generates more panicked phone calls than almost anything else I dealt with in my career. Question number 4. Did Social Security send you a letter saying you were overpaid at some point in the past? Because if they determined you received more money than you were actually owed, the agency is required by law to try to recover that money. Whether that happened because of an honest mistake on their end, a change in your circumstances you did not report in time, or any other reason, the outcome is the same. And as of a policy change that took effect in April of 2025, the default rate they will withhold from your monthly check is 50% of your benefit until the entire overpayment amount is paid back in full. For someone relying on that check to cover rent or medication, that can feel like a genuine emergency. But here is what almost nobody tells people in that moment of panic, and it is important enough that I want to walk through it carefully before we move on. You have real options, and you have 90 days from the date of that notice to use them. First, you can request reconsideration if you believe the overpayment amount is simply wrong. Second, you can request a waiver if you believe the overpayment was not your fault and repaying it would cause you genuine financial hardship. Third, even if you agree the overpayment happened, you can request a lower withholding rate than 50%, sometimes as low as $10 a month, simply by showing Social Security your actual monthly expenses and demonstrating that the full withholding would leave you unable to cover basic needs like housing or food. If you act within 30 days of receiving the notice and file any of these 3 requests, Social Security generally will not begin withholding anything while your request is being reviewed. So the very first thing to do is respond quickly, not silently accept whatever the letter says. And that brings us to a very different kind of debt, one that has nothing to do with Social Security's own mistakes. Question number 5. Do you have a federal debt hanging over you, something like unpaid federal taxes or a defaulted federal student loan? Because the Treasury Department has the legal authority to collect those debts directly out of your Social Security check through something called the Treasury Offset Program. For most federal debts, the government can take up to 15% of your monthly benefit, and by law they are required to leave you with at least $750 a month. Though I will be honest with you, that $750 floor was set back in 1996 and has never once been raised, so it protects far less of your income today than it was originally designed to protect. Unpaid federal taxes are by far the more common version of this for retirees, since almost anyone can end up owing the Internal Revenue Service at some point, and the Internal Revenue Service can also levy up to 15% of your check. But I want to show you what this actually looks like for a real person, because the numbers on paper never feel real until you see them applied to an actual situation. Picture a man named Martin, 71 years old, receiving $1,800 a month in Social Security, who fell behind on a federal tax bill several years ago after a rough stretch following his wife's medical expenses. The Internal Revenue Service moved to levy his benefit, and at the full 15% rate, that comes to $270, taken directly out of his check every single month, leaving him with $1,530 to live on. Martin did not know he could set up a formal payment plan directly with the Internal Revenue Service. And once he did, the agency agreed to a smaller, fixed monthly amount instead of the automatic 15% levy, which gave him back control over his own budget instead of having the government decide it for him. The lesson here applies whether the debt is federal taxes or a defaulted student loan. Contacting the agency directly and proposing your own repayment plan almost always produces a better outcome than letting the automatic levy run. Now, let us look at the one category of debt where even this kind of negotiation has almost no power at all. Question number 6, and this is the one with the least protection of any of them. Do you owe court-ordered child support, alimony, or restitution? Because unlike every other reason we have covered today, there is no $750 floor protecting your check here at all. Depending on your situation, up to 50%, 60%, or in some cases, 65% of your monthly benefit can be withheld to satisfy a court order. And if the support obligation is significantly behind, an additional amount can be added on top of that. This is the one area where Social Security has essentially no discretion to soften the impact, because it is enforcing a court order, not its own internal policy, which means if this situation applies to you, the place to address it is directly with the court that issued the order, not with the Social Security Administration itself. And I want to walk through what this actually looks like in practice, because the difference between this and every other question we have covered today is significant. Picture a man named Douglas receiving $2,200 a month in Social Security, with a child support order from decades earlier that fell into arrears during a period of unemployment. Because he does not have another spouse or child depending on him, the court can garnish up to 60% of his benefit. And because the order is significantly behind, an additional 5% can be added on top of that, which in Douglas's case means well over half of his monthly check can be withheld before he ever sees it. Unlike Martin's situation with the tax levy, Douglas cannot simply call Social Security and negotiate a lower rate, because Social Security is not the one enforcing this. The court is. And the only real path forward is going back to that same court, either to modify the order based on his current income or to work out a formal repayment arrangement that the court itself agrees to. This is the one area on this entire list where the fix has to happen outside of Social Security altogether. That brings us to something I want to correct before we close out today. There used to be a rule that cut Social Security benefits for people who also received a pension from a job that did not pay into Social Security, like many teachers, police officers, and firefighters. And that rule, known as the windfall elimination provision and the government pension offset, was fully repealed by the Social Security Fairness Act, signed into law in January of 2025. It no longer applies to any benefit paid for January of 2024 or later. If you were told years ago that your spousal or survivor benefit would be reduced or eliminated because of a government pension, and you never bothered applying because of it, I want you to go back and apply now, because millions of people are receiving increased checks, and some are receiving retroactive lump sum payments simply because this old rule that used to genuinely cut checks does not exist anymore. Now, let us bring all 6 of these together, because knowing which ones apply to you is only half the work. So to recap the 6 questions: working while under full retirement age and earning above the limit, total income pushing you above the taxable thresholds, income high enough to trigger the Medicare surcharge, an overpayment notice from Social Security, a federal debt like unpaid taxes or defaulted student loans, and court-ordered child support or alimony. If you answered yes to any one of them, you now know exactly why and exactly what you are allowed to do about it. If you know a parent, a neighbor, or a friend from church who might be dealing with one of these situations right now without understanding why their check changed, please share this video with them today. And if you have got a question about your own situation, drop it in the comments. Every Friday, I answer real viewer questions over on my posts tab. If this helped you, hit that subscribe button and the bell so you catch every video the moment it goes live. This channel provides educational information only and is not affiliated with the Social Security Administration, Medicare, CMS, the IRS, or any bank.